Show me that riff.
Okay.
Alright guys, that's your opening song for the week. Thought it was appropriate considering the way the market's been recently. I really like this guy's channel. Does some nice covers. I don't always like covers, but Sultans of Swing is a great song, and I think he did a good job recreating it. This is his channel if you're interested. I can't play a lot of mainstream music on YouTube or they'll copyright ban me, so have to play a lot of covers and stuff like that. Anyways, I'm going to try to play some of these kind of covers and remixes and stuff to open up my videos and see how that goes. Hopefully I don't get copyright flagged for stuff like that, but we'll see. Anyways, top bands for me. Let me know what your top bands are. Mine, number one, Led Zeppelin. Just love everything about Led Zeppelin. You can't beat Led Zeppelin. I could listen to it all day, every day. Just great band. Number two is Jimi Hendrix. Would probably be number one, but he died very young, tragically, obviously. Number three is Pink Floyd, just because extremely unique. Nobody's been able to reproduce that sound. Just incredible. And I like a lot of bands, like a lot of music. Obviously, I'm more of a rock guy, as you can tell, but those are definitely my top three. Let me know what yours are. So for this video, I did a couple blog posts on Medium. Read through those. I'm going to talk about a lot of the same things I talked about in those blog posts, but I'm going to add a few things, so hopefully you do read the blogs and watch this video. The general theme is tech needs to start participating. Tech's definitely had a bit of a reset. The other sectors and indexes really haven't. There's quite a few that have said that, like, there's no fear in the market at all. I don't agree with that. I think there was some fear, not as much as maybe we need, but I do think there was enough to definitely push us new highs on Russell and S&P, but Nasdaq needs to start participating. I don't think Russell and S&P can continue the uptrend forever without Nasdaq. I don't see that as likely. Anything can happen. Which brings me to my thought of the week, which is think in probabilities. I see way too many people that are just way too confident in what they think the market's going to do. The market, there is so much randomness that you can't be that confident. It's dangerous thinking, I think, in trading and investing to be 100% sure of an outcome. I always think of probabilities, and it's fairly rare that I'm like, that I lean extremely strongly in one direction, but it does happen, and that's when I size up. Other than that, I keep my size where I think the probabilities lie. If I think it's 60, 75%, 60 to 70% chance we're going up next week, well, my size is going to reflect that. But it's 80% chance, my size reflects that. So just think of probabilities. I think it's very important. A couple tweets that I liked this week. Nasdaq had a 10% correction. For me, that's just a sign that there was some fear. And you can see the back test, fairly positive, as you would expect for Nasdaq after that kind of a correction. This is what I'm saying as well. I agree with this statement. Tech is going to have to participate. Yeah, and I think there was an overfocus on rates. Definitely there was some overcrowding in tech prior to tech's entering this malaise it's been in for basically about 6 months now. Since the fall, tech hasn't done much. A lot of it was overcrowding. But rates were a factor. I'm not saying rates were not a factor. The problem with rates is they rose too quickly. It's not so much that they rose too quickly. This is interesting. QQQ short interest, highest on this guy's chart. I don't know if he has data going back further than that, but highest since February 18th. Very interesting. So some proof that there was some fear in the market. Which brings me into this. This chart has been one that on Sentiment Trader that I've kind of been really curious about, and I like it. I mean, I think it's something that has a lot of potential to be something I use more often. And basically, what this is basically it's just comparing the trading volume in QQQ versus the underlying stocks. So when this ratio gets very high, there's a lot of volume in QQQ versus Apple and Facebook and the underlying stocks. And in general, big spikes are seen near lows. Interesting about this is I believe this is the second highest spike ever on this. Yeah. That I found interesting. It's further proof that there's some pretty good amount of fear that came into Nasdaq and tech. So we'll see if that's enough to get us to new highs. I mean, Nasdaq has quite a bit of overhead supply to work through. If it can, I think it can push new highs too here, but we'll see. SPY liquidity premium, not as extreme obviously, but still fairly extreme, even more extreme than the fall, which is interesting. So I think there was some fear. There was fear. It's not as easy to spot, and it's not being talked about as much, but there's definitely was some fear. These next two charts are Nasdaq and NYSE short interest, and these actually are reports that come out bi-weekly from the exchanges themselves. And this is the actual short interest of the entire index. So all Nasdaq traded stocks, not just the index. This hasn't been updated in a bit, but there's a decent amount of short interest on Nasdaq traded issues. Not being talked about a lot because I guess it's not bearish enough. But now, interestingly, NYSE is completely the opposite. Now, with both these charts, I think possibly some way of normalizing would maybe help, normalizing it to notional value in some way. But interesting nonetheless. NYSE, obviously, if you look at it, depends which time frame you look at it. Short interest definitely in the past was lower, but shorting wasn't something I think in the 90s that was near as common either. So. I mean, now you have hedge funds that's all they do is short. And this is related to the QQQ short interest. Let's look at QQQ short interest actually. So this number here is the same one from the Hedgepedia article, or tweet. Certainly very high, highest on this chart, and it like says the highest it had ever been. Looking at a couple others, Facebook It's been higher. It was higher last year after the March crash, but still getting back up there in terms of short interest. Amazon, very high. Not quite to March levels, but it's definitely getting there. So that's just proof that there's more bearishness out there than people realize. Now this is NQ COT, so we're going to get into COT reports. NQ dealer positioning was higher in September last year, but I'm not sure it's been higher than that ever. Yeah. And dealers in general are not contrarian. Yeah, in general, if dealers are long, you want to be long. Dealers are short, you want to be short. I mean, it's not quite like that. Generally, it's more about extremes, basically. If dealers are much more longer than they have been historically, that's usually a good time to be long. And it was there, although yes, we had some volatility, but and they didn't get real active in March, which is interesting. But again, we're only looking at one COT report for one futures contract. But it is significant that dealers are second highest level of long they've ever been. Now, non-reportables are typically where you might find your retail. And they're net short and at a relatively low level. That's mildly bullish, I would say, this COT report. This is my aggregated COT dealer positioning. And let's see. You can see a couple things here. One, notice these times that we get extremely long, or the dealers got net long above zero. Zero is here, first of all. So it's rare that the dealers actually net long the futures contracts. And if you think about that, indexes mostly go up. So speculators are mostly long. And it's only those times that the speculators are excessively bearish, like very excessively bearish, that dealers get long. It's extremely rare. When you see this signal, it's multi-year bullish every time. I know it's only 2 out of 2, and we're looking at so far 3 out of 3, and see if this plays out again. But there's many other metrics that were aligned like this after the March crash. So this is still a factor here. You still have to factor this idea in, that the dealers got very aggressively long back in April, May, June timeframe. That's still a factor. Also, very notable was how short they got before the February crash. That was an extremely good signal. Short signals don't always work quite as well, but you got a fairly good one back in January of 18. And sell signals can be early, but these were clearly early here. It's just harder on the bear side of things. Since the 2009 bottom, though, this data has been very accurate and good and reliable. So I really like to use it. I don't think people use it as much this way with the aggregated positioning like I do, but it's definitely a good way to look at it. In my opinion, the more data you can look at in terms of broadening the data set out, like if you're just looking at NQ COT, it's much different than looking at all the COT reports combined. So one thing you'll notice about this is the kind of the upwards drift here on the dealer positioning. So this next chart, the next chart will normalize that. So, and again, same ideas. this was 100th percentile. So roughly here would be your 90th percentile cutoff. And so anytime they've been above 90th, for the most part, has been a good time. Although prior to 2008, this was a little bit shaky. Futures weren't near as active then as they are now, obviously. So as futures have gotten more notional volume, this data, I think, has become more and more accurate. That's just my opinion, but since 2009, basically, this data has been very, very good to use. And one thing you'll notice is this is a 60th percentile, I believe. Yeah, I think it's like 61 percentile. Pretty good increase recently. And by 60th percentile, this is a rolling 5-year percentile, so that's how we're normalizing this, so we don't have that upwards drift. So this next page, we're going to look at a back test of that. So we were 61. I looked at 55 to 65, opening it up a bit. So kind of in the middle of this range is where we're at. Quite bullish back test. Now, the main thing on these back tests that I share is this row right here. This is versus history. So if you look here, 0.03 means we were 0.03 above the historical average. So the average one-day return is 0.03%, and the average return for this signal is 0.06%. That's what that means. If you've ever wondered when you see my back test what the hell all this shit means. Now you know. So yeah, in general, green means good, red means bad. Percent positive, pretty high. Yeah, it's a good back test, to say the least. Now this next back test comes back to this idea of going back here. Comes back to this idea of these mega extremes above 90th percentile. That's what we're going to look at here at this back test. All the times we got to that level. As you can see, obviously in 2020 this happened many times. And sometimes these back tests get skewed by repeat signals. Even if you remove the repeat signals on this, it's quite bullish. In fact, it probably gets more bullish if you remove the repeat signals. Anyways, 2007 was obviously the one bad signal, potentially anyways. I mean, I think maybe for a little bit longer you might have got some upside, but then it was disastrous. 2010 was kind of that sideways year, but it was a bullish year. 2011 was kind of a major bottom. 12 coming out of that 11 bottom, and then 15 and 16 we had a bunch of prints. We had that very long sideways period there, kind of a somewhat major bottom. We roared higher after we resolved that, and then now. So this back test is wildly bullish, and this is still a factor. For me, you still have to factor in when you have a extreme that significant. It's roughly a year from now. It was only a year ago. It's still a factor here. You still have to consider this as something that is a factor in the current market. So I'm considering it as a factor. Now this is the COTBASE with the legacy reports combined. Commercials did drop a significant amount, but I put a lot more weight in the disaggregated reports, which break out your dealer and your asset manager positioning. Commercials are dealers and asset managers on your disaggregated reports, and asset managers to me are not as much smart money as they used to be. But regardless, I would have liked to have seen the commercials stay net long. And it's not necessarily Nice to see small specs add so much to longs. However, I still view COT, the recent COT action, as bullish, and the long-term COT action as bullish. That's how I'm classifying it. FANG, dark pool index. So Amazon, Apple, Netflix, Google, Tesla, Microsoft, NVIDIA. 10-day moving average of their dark pool activity, and it's been pretty weak. It's trying to come back, but we'd really like to see this improve further. It's trying to improve right now. We'd like to see more out of that for sure. FANG's kind of been nowhere if you look at like charts of Amazon. It's gone nowhere forever. You really want to see some of these stocks start to improve their price action for the bull case. I'm definitely leaning bull here, but we need to see tech make a bit of a comeback here for this rally to have legs, I think. I thought I'd look at semiconductors. A lot of people think semiconductors are kind of a bellwether for the market. I'm not sure about that from testing I've done, but it's an interesting idea. So this is the SOX ETF, Semiconductor ETF, 10-day moving average of the dark pools, and been weak for a while, but they're trying to, it's been pretty strong recently. So let's see if that trend continues and dark pools continue to buy semis and bring this average up further, which is what we'd like to see. We'd really like to see this be up here within the next few weeks. So that's where we want that to go. SMH Semiconductor ETF, 10-day moving average, same idea. This one is actually looking better. Now, when it comes to ETFs and dark pools, not as big a factor as the underlying. So with that, I have this selectable ticker dark pool index on TradingView. You can put up to 10 tickers in there. And these are the top 10 holdings. You can see the tickers here. Top 10 holdings of SMH. And I think I have the 5-day average on here. And we really want to see this improve. It's been very weak. Tried to uptick a bit this last week, but this still is not looking very healthy in terms of dark pools on semis. However, you know, it's been weak for a long time and it's remained in an uptrend. So how much weight can we put on that? I don't know. I think dark pools get more useful the more data you include. That's why the Squeezemetrics DIX I think is very useful. It smooths out the irregularities of all the individual issues. But regardless, we want to see this continue. XLK, so looking at tech specifically. This is just the ETF. Not a very good print on Friday. It has been trying to improve. But again, it's just the ETF. So don't put a lot of weight into it. This is the 10-day moving average of the top 10 holdings of XLK. And same story. Been improving, needs to improve more. This is SPY, Qs, and IWM combined. And this has been fairly healthy recently. But these index ETF dark pool, the dark pools on the index ETFs, to me, just aren't as reliable. A lot of noise on these, but nevertheless, it is a good sign here. This is the total dark pool index moving average from trading volatility. Pretty low, but this is an equal weight DIX. I don't have historical data on it, so I don't know if I put a lot of weight on this. Until I can actually test it, you know, I don't know what to think of it. And I think market cap weighted in some way is a better way to look at it. That's just my view. This is the actual DIX. nice improvement this week, for sure. Finally. It's been very weak for quite some time. So it's nice to see this. Want to see it continue for sure. Another thing I want to point out, just like COT, notice this. That's one of the highest we've ever seen. And if you start looking at moving averages, which we will, one of the highest moving averages we've ever seen of DIX. In fact, it might have been the highest ever. You have here, you have here, and you have here. Those are kind of your three major times that the DIX got really, really aggressive. So we're going to look at that. We're going to look at a couple back tests now of DIX. So the current configuration for the 5-day moving average is 43%, which puts it at the 61st percentile, very similar to COT. So widen that out a bit. This is what you get for a back test. Not wildly bullish, not bearish necessarily, but it is below average for the next month in terms of returns, but above average after that. So a decent longer term back test here for DIX. And this is the 20-day moving average got to 95th percentile earlier this year, or last year, after the March crash. And it's a rare signal. We saw it after the December, a little mini meltdown, 15 and 16, and again back in 11. It's been a wildly bullish signal when we see that. And yeah, it's just unbelievably bullish when you see that. Still a factor here. People are forgetting what happened last year already. That's still a factor. Despite some issues, you still have to factor this kind of thing in. Wanted to throw Tesla up here just because it does affect Squeezemetrics DIX a lot right now. And part of the reason the Squeezemetrics DIX improved so much was because Tesla improved a lot. So I don't know what to make of that. But for now, I'm just viewing DIX the way I've always viewed it, and not really changing my opinion of it a whole lot just because of maybe the Tesla effect might be skewing the results a bit. We need more data, I suppose. Insider transactions, still kind of in the bearish area. However, I like to look at Sentiment Trader's version, which is seasonally adjusted. And it's kind of neutral here. There has been a lot of insider selling recently, which is not the best signal, but with insider selling, it's just not near as reliable as insider buying is. And that goes for a lot of things in terms of the market. So that's where people get tripped up, is they see a lot of insider selling and they want to sell. You can't really do that. You can do that if there's a lot of other things aligning with that. You need more than like 2 or 3 metrics aligned to bearish to get bearish, the indexes. And that's where so many people get tripped up, I think. The corporate insider buy-sell ratio has not been healthy for quite a while, but it can go through that for long periods of time. One thing to consider is buybacks have kind of resumed by a lot of these companies. So that may offset some of this. If we're in a situation where buybacks were still basically banned, and you have a lot of insider selling, that obviously would be a bigger factor. I'm not too concerned about the insider selling just yet. If it continues for a long period of time, can become a problem. And I think we'll probably see it tick back up here eventually. Anyways. Now fund flows. We have had some gigantic inflows, which is not necessarily bullish. But consider that we've had mostly outflows for the last few years. And we're just now starting to get some inflows. Most people are not considering that, but you do need to consider that. Now, When we look at this one, we're looking at, this includes stocks and equities and non-equities. It's all stocks, all domestic stocks. So you have some bonds in there. You have all sorts of different things in there mixed in. This next one looks at fund flow for just equities. And you see a lot more inflow on that and some very high inflow recently. I don't view this as bullish. When you start back testing this, it's not necessarily a good sign when you see that kind of inflow, especially after a massive rally. So this is definitely a bearish factor. And I think it's one of those factors that eventually is going to catch up to the market. Especially if Nasdaq cannot get going, and especially once the seasonality switches in May. We have a pretty good seasonal run coming up. I'm going to show that. But around May, we could run into some problems that finally resets some of the euphoria in the market a little bit. The Lipper fund flows, this report is a little bit more current than the other reports. I forget the source for the other reports. Here's your source. Bloomberg, apparently. But Lipper's a little bit more current, and we've seen big inflows again on this. 17.1, and this was gigantic back in early February. So that's not bullish per se. However, I'm going to show you some more charts that is to some extent some kind of proof that we could continue to see quite a bit of inflows. We'll see. I'll show you. There's potentially a lot of cash still out there. So this is your flows. We've had a lot of outflows. We're starting to get major inflows. Sometimes usually you see major inflows after a major washout move and not so late after the washout, which is what's one of those things that's been very interesting about this market is we're seeing a lot of things you usually only see after a massive dip like in March, and now we're just now seeing a lot of this. There was a lot of pessimism after the March lows that took forever to wear through. Now you're seeing a lot of things start to come into play that you normally come into play a lot faster, which is interesting. This is just talking more about retail and the fact that I do think retail will see some pain this year at a few points in time, at least once. We'll see some real pain. I don't think they've seen much pain yet. I don't think they saw it last fall in that little correction. In this correction, I don't think they've seen a whole lot. And you can see that here. Minor dips here. Eventually, you're going to see some reset in some of these extreme Momo names. This is talking about the cash on the sidelines. By the way, these all come from the MarketEar newsletter, if you're interested where I get these. Households that haven't participated in the market for a long time, and they're starting to here. So there's potential, a lot of money out there, especially when you look at this chart. There's a lot of cash in savings accounts out there. And with value of the dollar going down, eventually people are going to realize they have to invest some of this. Now this is another, this is my favorite view of retail exposure, the one from TD Ameritrade. And this isn't a good look. Retail is clearly getting pretty euphoric here. Eventually it'll catch up to them eventually. I don't think it's going to be a bear market or anything like that. I just think we'll see some of these Momo names get really, really beat down. And a lot of them were down like 50% recently, but I think you'll see much worse. Coming this summer when seasonality shifts, I think could be when it happens. It could happen whenever. I don't know when it's going to happen, but I do think it's fairly likely sometime this year. You're going to see a little bit of a reset on some of this kind of stuff. This is from the Chris Ciovacco Capital video. And same thing in terms of savings. There's a lot of money out there. Personal savings has gone up quite a bit. And you can see this is the pandemic. I'm going to show the M2 chart later, which I'm sure you've all seen, but clearly the stimulus has been massive. And that's why I think we have a long ways to go. And the Fed's not planning on tightening anytime soon. I think this bull market has a long ways to go. Because of that. There's just so much stimulus out there. I think you're going to see records set on positioning and sentiment before this thing tops. And we're not there yet. There's some things getting very extreme, and many things still are not very extreme. So this is NYSE available cash. It's quite low. Yeah, I don't know if there's a way to normalize that, but maybe that's a mild concern there. But then you look at Nasdaq, and it's the opposite again. I don't know what to make of this when you have these opposite like this. Nasdaq just seems like there's a lot of pessimism out there. I think more than people realize. I don't think it's all everybody's all piled in anymore. I think Nasdaq could outperform for the next couple months before we top, possibly before the next top comes in, which could have been Friday. It could be 8 months from now. You could see Nasdaq outperform just because I think there is a bit more pessimism for Nasdaq than there is for the other indexes right now. This has become one of my favorite indicators, the hedge fund exposure from Sentiment Trader. And there's a hedge fund exposure chart that floats around on Twitter that I don't think it's a bad chart per se, but what this does is factor in the returns for the hedge funds versus what the market's doing. So that gives you an actual picture of what their actual exposure is. And these guys have a very big, consistent track record of getting very long before at least an intermediate term top. And there's anytime with bearish type of signals, you'll get a huge delay a lot of times. That's common. But look how long they were above the red line and way above the red line before February. We're nothing like that now. However, you know, it's finally, since March, they have not been very bullish. And they're just now starting to get slightly excessively bullish. And yeah, the most bullish they've ever been was right before the Volpocalypse little meltdown we had there. I've tested it and I really like it. Pretty consistent indicator. We got a nice reset on this correction. Would like to see more, but it's pretty nice. This is just a daily news sentiment index. Again, we can go much higher on this. So we have plenty of room to run on this thing before we could have some issues. Secondary factor is something I've started looking at. Leverage long assets. Highest I'm pretty sure it's ever been. This is not necessarily bullish. This is more retail exuberance. And the leverage shorts also increased after March, finally getting back to February levels. This is also not necessarily bullish. It's just one factor. The surveys, I'm not a big fan of the surveys, but would like to see AAII not be so bullish here. AII is pretty heavy retail, and they're quite bullish. It's not necessarily as bearish as you think, but it's not bullish per se. Name is your active managers, so more of an institutional survey. Big drop this week. I don't know what to make of it. Name is not as contrarian as AAII is. When the active managers are bullish, it's not necessarily bearish, as you can tell. But a big 1 week drop like this, I've never tested it, so I don't know. I would say it's probably bullish, but would have to test it, obviously. And this is a sentiment traders version where they just combine all these surveys. It's still pretty elevated here. And I mean, I have back tested this one with their back tester, and it's really not as bearish as you think when this is above the red line. This thing about bull markets, in bull markets, you're going to have a lot of bullish sentiment. It's just, you can't just always be a contrarian with bullish sentiment. This is one of my favorite, between city panic, euphoria, CNN, fear and greed. I like this one much better because I've compared them. I don't really have the data, but I kind of cobbled together some data one time, kind of manually, and this one definitely is the best compared to those two. And it's at 7.2. It still has more room to go up. It's not necessarily bullish anymore, but it's still at a level we can still continue to the upside. We may see that get into the extreme bull before the next top. We'll see. So these next two charts here, this is equity. This is the actual put call open interest ratio, not volumes, but actual open interest. People have been heavily focused on the equity put call volume ratios. That's what you see all the time. But this is the actual open interest. And it took a long time for that volume to actually transition into open interest. And notably, it's very notable recently that more and more calls are being held. This is not necessarily bullish. However, looking at the next page, this is just, these two charts really symbolize this entire market right now to me. The index open interest ratio remains very high, near 2-year highs. I only have 2 years of data on this, but index put call ratio is still very high, and you have to consider that index options notionally are much larger. This is why we can't get a sustained correction to clear the retail euphoria, is because institutions continue to hedge pretty aggressively. So what a lot of people don't realize. And it comes back to the VIX. This is just the VIX. VIX, to get a sustainable correction, I still think we're going to need VIX under 20. We need it to normalize again. And it's hard for it to normalize when there's so many puts being bought and held on the index level. But yeah, so when we see these puts not being held nearly as aggressively, you see VIX under 20, that's when you're going to want to get very cautious this market, because there is a lot of excess in terms of positioning and sentiment out there. It's just, it can't really materialize into sustained pullbacks until we get some normalization here. It's just, it's not that it can't, obviously. It can. It's just difficult to do. It takes a lot of things all lining up at once. So you'd probably need a lot of news all hitting at the same time. You'd need a lot of catalysts all happening at the same time to get a sustained pullback right now. I think my view, prediction, whatever you want to call it, is Nasdaq gets back to its highs. S&Ps go to new highs. I don't know how high, 4,050, maybe even 4,100 plus by May. And then you see normalization. And then the summertime hits. People go back to work. You get the economy reopened. People go back to work. They're not sitting at home with their stimulus checks as much anymore. Maybe the unemployment drops off significantly. And then you might get a real correction. That maybe not just depth, but the problem with our corrections, they've just been so short and so shallow since March. They have not been able to reset any kind of sentiment to the degree we'd like to see for a healthy uptrend. This balance sheet, this is why I say it's going to take some massive extremes to get a major chop. And we're far from that yet. But short to intermediate term, we're getting closer. I've compared 2020 several times to 2009. And if you do that, let's go back. These overlay charts are always a little, people love to do overlays, I've noticed. I'm going to do it too. Why not? So here's after the 09 low, and it includes 2010 and obviously 2011 as well. If 2020 was similar to 2009, and clearly it kind of was in terms of price action, we could be very close to this 2010 period here, which was very volatile and sideways. Maybe one more run, and we could get we could have your first pretty major pullback. It could happen fairly soon if we're following that same kind of fractal, if you will. I know some people love fractals. This is M2. Again, the fastest increase probably ever right here. And this is on log scale. So that's why there's a lot of ammo out there that's going to keep getting pumped in. And it's going to take a while to see a major top. And by major top, what I mean by major top, I don't mean that we're going to have a bear market, a 1929 crash. I'm talking like a top like this. Like it could be, I mean, this is a major top to me. Look how long we went sideways, and it's very volatile. And this is actually the biggest dip we had since 09 at the time. Or a top like this, or definitely a top like this even. I think I would say we're at least a year before we get a top like that. At least a year. That's my opinion. I think the easiest money's probably already been made from the March lows, obviously. But I think there's more money to be made. People are going to get bearish too soon like they always do, and like I often do. I'm no better than anybody else out there, trust me. I make tons of mistakes. But I think there's still more money to be made here. I know valuations are crazy. I know there's a lot of extremes in retail, like some of the most extreme stuff we've ever seen in retail right now. I know that's happening, but you got to get everybody on one side of the boat. In February, it was that way. Everybody's on one side of the boat here, and it was that way here too. Actually, here was probably the most extreme sentiment ever got. If you really examine it and look at it, it's the most extreme sentiment ever got. What do we got next? Seasonality, that's kind of where we're at. Very good stretch here seasonally coming up. We'll see if that comes into play. Some order flow. Again, this is cumulative delta. If you don't know what that means, it's just when somebody market sells, this goes down. When somebody market buys, this goes up on S&P 500 futures. So when you have price rising with cumulative delta going down, that's in general bullish, and I have done some basic testing of that, and it does play out. It's not as it's hard to do testing on order flow, but it is something I intend to do eventually. But this is kind of the way I've kind of always viewed order flow is correct according to the testing I've done. But order flow can change so fast too, and it's more of a short-term thing. I'm trying to look at it in a long-term manner. Maybe that's not correct. I don't know. On the left side here, you have delta at price. So over here, you have your volume profile. Most people are familiar with volume profile. This is actually looking at the delta within these bars over here on the right. And you can see a lot of sellers potentially trapped in this range here. And we're above that, so I view that as bullish. Some people might not. Some people view it as, you have to have the delta to get an increasing price. You have to have some delta, some bullish delta. And yeah, I agree. We're going to need to see the delta do this to get this breakout here to sustain. This is RTY, same story, not going to go over it. And this is NQ here, same story as ES. So Synopsis, I still lean bull, short to medium, but anything can happen. It's not like super high probability, but I do lean bull. This is my book, just finished it. It's up for pre-order. If you buy that, you get access to my Discord. And what this book is, it's just research I've done on the best times to reduce risk in the market, SPX, when you're trading SPX index like I do. So it's not like a perma bear Bible, like it may sound, because I'm definitely not a perma bear. But it's just a bunch of back tests and research I've done on what truly does shift probabilities to bearish when you trade indexes. Okay, so what's this? This is the number of push-ups I'm going to do per new subscriber on my YouTube account. Now, currently, I'm at 50 subscribers. So any new subscribers I get this week, I got this set for 1 through 20. And we're going to roll it, and that's how many push-ups I will do for each new subscriber. So 11. We're going to do 11 push-ups for every subscriber this week. And I'll put that at the end of next week's video. I think that's it. I think that's all I have for this week. Have a good trading week. If you have any questions, let me know in the comments. Let me know what your favorite band is. Yeah, hopefully I see you guys in the Discord soon.